Warm welcome to another week ahead video, guys. This week's video will cover the trading week running from Monday the 1st to Friday the 5th of November 2021. Now, this week, guys, we've got a jam-packed schedule. We've got the RBA coming up on Tuesday, FMC on Wednesday, Bank of England on Thursday, alongside OPEC Plus. On Friday, we've got NFP, we've got Canadian jobs, and of course, we have those key events that normally feeds into NFP scattered throughout the week, like the ISM manufacturing PMI, the services PMI, ADP, etc. So it's going to be jam-packed. Our focus for this week ahead video, though, will be on the Bank of England, but that doesn't mean that we don't see tradable opportunities for the RBA and the Fed. We think all three of these events are going to be very important, especially considering the recent developments we've seen in rate markets, especially the front end of the curve, really across the globe. So definitely key three events that you don't want to miss in this upcoming week. Now, taking a look at the Bank of England then for a second, it seems the bank have recently been backing themselves into a little bit of a corner by all the hawkish comments we've had from the likes of Governor Bailey and Saunders and Pearl. It seems that the collective hawkish message we've had from these members was one of the key drivers that has sparked the recent acceleration in rate hike picks, of course, alongside energy prices, alongside inflation, price pressures increasing, etc. But it seems that all three these members have suggested that the current levels of inflation, even though it is still expected to be more transitory in the medium term, is currently high enough for the bank to act in terms of rates. Now, with inflation expected to remain higher for a little bit longer than previously anticipated, and with hawkish comments from the BoE members like Bailey, like Saunders, like Pearl, money markets have now been overly aggressive over the past couple of weeks in their expectations for rate hikes. If you think about it, given where inflation is at, given the economic developments, etc., a 15 basis point hike from the current 0.1%, taking it back to a 0.25% in quarter four, it doesn't really seem that far off. It doesn't, it seems totally understandable, but it's the expectations that's expected after this 15 basis point cut, which is really just crazy at the moment. If you think about it, rates market is fully pricing in 425 basis point hikes by the end of next year. If you take a look at the SONIA futures expectations right now, you can see that for the December contract next year, it's got an implied tightening of 1.18. Now, that's not the implied cash rate. This is the implied rate minus the cash rate. So you can just see what ridiculous expectations we've seen priced in for rates markets for the Bank of England. It's also worth noting that the reason why this is also surprising is that it doesn't seem like there's a consensus among the Bank of England, the broader MPC right now, for faster hikes and especially higher rates, because we've had recent communication coming out from BoE's Man, BoE's Tenrero, which doesn't really support the view that we've heard from other more hawkish members. Also, with global supply chain disruptions as well as the base effects from 2020, it is expected to see UK CPI, of course, well above 4%. Now, the recent surge we've had in energy costs was, of course, a key catalyst for further increased hike expectations. Now, the price cap on gas prices, which has been a saving grace for UK consumers right now, that is set to see some sharp increases from next year, April, which is something also to keep in mind from a potential demand destruction point of view. But, if you just take a look at the chart itself, on this chart, we've got the UK natural gas futures in yellow. We've got the SONIA December contract for 2021 in green overlaid on that. Now, what you can clearly see is that the UK natural gas prices, we had that huge jump to the upside a couple of weeks ago, over 200% rise from the start of September. But what's even more important for me about this, especially feeding into the inflation narrative right now, is that we've seen a 60% drop from the highs. So, if natural gas prices was this massive catalyst that created all of the additional inflation fears, then surely this 60% drop we've had should already have abated some of those fears if you just think about it logically. Now, it's also worth keeping in mind that plenty of BoE officials, including Governor Bailey, has been very clear to explain that you can't just hike away supply chain disruptions. You can't hike away high energy prices, which makes their recent silence, I think, regarding the market's very aggressive expectations all the more surprising going into this meeting. Now, all of this has meant that the Bank of England has, in our opinion, backed themselves into a bit of a corner here where they run the risk of creating a lot of unwanted market volatility if they disappoint markets, in either direction right now. Now, it's very interesting to note that if you take a look at sterling itself, sterling has not been oblivious to the risk of the Bank of England possibly disappointing markets, and possibly seeing a nasty repricing on the rates front. Because if you take a look at sterling on this chart, it hasn't really benefited from those rate bets. Remember that when we take a look at these SONIA futures charts, it's really from the start of September, that first week in September, when we saw a massive acceleration to the downside. Now, if we compare that same timeline here to the British pound on this currency index, we can see that it hasn't really gone anywhere compared to the other majors. It's been very, very range bound. Now, compare that to the rates markets, right? Since September, when we saw that big flush lower in SONIA futures, even though the pound has been range bound, it's been the exact opposite from a rates point of view. We've seen the front end of the curve absolutely smashing it out of the park. What's even more interesting, though, apart from the front end seeing that huge repricing, is we've also now started to see some yield curve inversion that's taken place. Now, even though the current front end is much steeper than just a month ago, which is in green, or 2 months ago, which is in red, what we have seen is we've seen a sharp move lower in the long end of the curve. Now, that is possibly implying here that the markets, it sees a faster lift off in the short end, or in the near term, but followed by a period of lower rates after that. Now, essentially, this is the bond market's way of saying that, hey, we think that there's going to be a faster lift off in rates. That's possible, but that it's possibly leading to the Bank of England putting it on track for a possible policy mistake, which is very, very interesting for sterling in the medium term. So with the Bank of England expected to lower their growth forecast at this meeting, also possibly revise higher the inflation forecast, the front loading that we've had in rates certainly looks like a potential policy mistake in the making, and a potential drag on sterling. Now, especially with tightening from both the fiscal side expected as well as now the monetary side expected, that could see some potential demand destruction going forward. So that might be what the yield curve is implying right now. Now, what is interesting is that despite money markets, fully pricing in a hike for Q4, it seems not everyone is convinced that it will happen at this week's upcoming meeting on November the 4th. Some is still calling for that hike to only take place in December. The rationale behind this, of course, is the bank's own guidance saying that, let's just see some of these comments. Talking about the labor market, talking about some of the information that they still need to get. They say that there was a high option value. This is the September statement, by the way. There was a high option value in waiting for that additional information before deciding if and when a tightening in monetary policy might be warranted. Furthermore, what's also interesting, though, which basically counters the argument for December and possibly makes November live, is they also said that all members in this group agreed that any future initial tightening of monetary policy should be implemented by an increase in the cash rate, even if that tightening became appropriate before the end of the existing UK government asset purchase program. So what they're basically telling us here is that, we want to wait for more information, but if things get really hairy, we won't think twice to hike rates, even if we still have quantitative easing going on. So that really means that it can go either way. Recent comments from the Bank of England suggest that, hey, November might be the more likely opportunity. That's also where I think money markets right now is placing the bulk of expectations. But again, the bank can still come out and surprise, and we want to be open to any eventuality on that part. Now, to sum up, the first question mark for markets in this meeting will be whether they actually go ahead and hike. If they don't, the question will fall on whether they give some firm guidance to suggest that that rate is coming in December. That's going to be the first question. The second one is whether they actually confirm or push back against the market's overly aggressive expectations for hikes next year. So this year is pretty much a done deal. The real question that the market wants to have answered is, okay, we've priced in a ton of rate hikes next year. Are you guys confirming that that's going to be a possibility or not? Now, when we take a look at some of the possible hawkish and dovish scenarios, on the hawkish side, remember that a 15 basis point hike is pretty much consensus right now. It's not a massive consensus because, like I said, some is still expecting that to possibly happen in December. But whether that happens in November and December, that's not really the focus point. If they do come out, though, this meeting and they hike by more than 15 basis points, potentially hiking to take the cash rate up to 0.5%, that's obviously going to be a very big hawkish tilt. Unlikely tilt, but definitely one to watch out for. Also, keep in mind that what's going to be very important, let's say they just come out with that 15 basis point hike, the vote split will be very important for us to watch, because if that's a marginal hike, let's say it's a 5-4 split, 5 voting for a hike, and 4 voting to stay on hold, that can obviously see a little bit of a buy the rumor, sell the fact reaction playing out for sterling. If you take a look at the current composition, we know Saunders is going to be set to be a vote for a hike. We know Ramsden as well. We know Pill as well. Governor Bailey, we think, is going to be comfortable. We know that Mann isn't going to vote for a hike. Well, at least, based on recent comments, we don't think she will. Tenrero either. Haskell also not going to vote for a hike. So that means that it's going to be up to Cunliffe as well as Broadbent to basically make up the balance of that vote. So in our opinion, it's likely, if it is a hike, it's likely going to be a 5-4 split. But obviously, if it's a bigger split than that, then it could be seen as more hawkish. A smaller split will be seen as less hawkish. So that's definitely important to keep in mind. Apart from that, what's also going to be hawkish if they don't push back against money market pricing for 4 hikes next year. So if they don't come out really strong against that, even though we don't think they're going to reach that 4 additional hikes next year, if they don't push back against it, it's going to give the markets more reason to price in even more aggressive policy. So that's going to be seen as hawkish. Also, apart from that, the updated projections, if that confirms a possible faster and tighter policy path, that's also something to watch out for. And then if they decide to end quantitative easing early. Now, we think that's going to be less important, though. It should be very much pointless at this stage, because quantitative easing, that program is expected to run off in the next couple of weeks anyway. So for them to end it early, it'll possibly be used more as a additional signaling from the bank, as opposed to a real impact on monetary policy. If you think about it that way, choosing to stop it now and just letting it run for the next 4 weeks, there's really so little difference in that. So not seeing that as a big one. But again, if they do all of these things and they end quantitative easing early, that's obviously going to be seen as just an additional hawkish signal from the bank and one to watch. In terms of the dovish side, if they don't hike rates, remember that markets are expecting them either to hike in November or December. Now, the challenge of this one is, let's say they don't hike. That's obviously going to see that knee-jerk reaction lower in the pound. But if they follow up with some really stern, really clear comments and guidance saying that, hey, we didn't hike now, but we are most likely going to hike December, that is going to take a lot of the sting out of a no hike situation. So even though we do anticipate a knee-jerk reaction lower, do make sure to watch out what they say about December, because not hiking now doesn't mean that they're not going to hike in December. If they don't hike now and they expressly say that they're probably not going to hike in December, likely only in February, expect a lot of downside for sterling to play out on the back of that. Apart from that, if they choose to really strongly push back against additional hikes, not like the ECB did this week, if they really come out laying it on thick, pushing back against that and arguing more in line of a one and done hike language, expect to see lots of downside in both rates as well as the pound. Apart from that, if the updated projection suggests a slower rebound, so if the downward revisions to growth and upward revisions to inflation is big enough, or if that divergence is big enough to suggest that we won't see those hikes coming next year, that in itself will be seen as more of a dovish tilt from the bank, also one to watch. And then if they have no change on the vote split for quantitative easing, remember last time around we had 2 dissenters. We had Saunders as well as Ramsden, who dissented on the vote split for quantitative easing to end it. So if we see that unchanged, we would also expect that to be slightly more of a dovish stance, especially if you're going to have some members actually voting for a hike. You would expect them to possibly also vote to stop that. But again, keep that in mind with those comments we had from them in the September meeting, right? They said that they wouldn't mind hiking even while the current existing bond program is running or asset purchase program is running. So that's going to be a lot less important to focus on. The focus is going to be on what happens to rates, what happens to their forward guidance. The QE one is really a less important one, like we said, because it's anyway going to be run. It's going to run off in the next 4 weeks after the meeting, so it's not going to be as important as the hikes question, the rates question, and then of course that forward guidance regarding next year. All right, guys, so that's everything from our side for this week ahead video. Like we said, it's not just the Bank of England to focus on. We've got the RBA as well. We've got the Fed coming up as well. All three of them can offer some great tradable opportunities. So really worth focusing on all three of them, not just the Bank of England. But as always, we will have a full rundown as well as some expectations, scenario planning for all three of these events in the terminal throughout the week.